Randy Ernst, he's the Vice President of Guaranteed Rate. I've known Randy, I don't know, what is it going on now?
It's going to be going on 11 years.
Wow.
Seriously.
Time flies so
Yeah.
fast.
We were a little bit younger then.
Yeah, we were.
Yeah. Damn.
But I've known Randy, and I like the concept of guaranteed rate, and maybe he'll explain a little bit about that. But the main thing for today's seminar is because there have been so many changes in mortgage underwriting in the last couple of years. And Randy will probably tell you there are changes going on every day. And sort of what you hear on the street could be different than reality. So I wanted Randy to be able to explain what these differences are, because if you understand them, you know what is going to happen going in when you decide to buy a property. There won't be any surprises and disappointment. So all about getting educated before you need to actually act. Okay.
Definitely.
So with that, I'll let Randy get started.
Okay. Yeah, underwriting has changed a lot over the last few years, but it has started to stabilize now. And things are getting a little bit easier to do than they were, but still there's a lot of nuances that people should know going into it. That they need to know these things, or else it could create issues for you when you're going through the process. So first thing I did is I put in here the packet, little advertisement. I apologize. You get a little advertisement this morning. But Guaranteed Rate was founded actually in year 2000. I started with them in 2001 as their director of sales, and later became their general manager. And about 4 or 5 years ago, I decided I didn't want to be in that role. I didn't want to be flying around the country setting up offices, that type of thing. So I got back into originations, and that's where I've been. I actually was ranked in the top 200 in the United States the last couple years in a row. And I've known Bert, like Bert said, for the last 11 years. And Bert does a great job. I like to associate with really good people like Bert, and that's anybody I usually work with are good people. And one of the things about Guaranteed Rate, you see, we have had tremendous growth throughout the last 11 years. We went from, when I started with them, we had 3 loan officers, and we had 1 little spot. Today, we have over 1,200 employees, and we have 70 offices nationwide. So over the last 11 years, that's how much we've grown. We were in the Fast 50 growing, top growing companies in the Chicagoland area for the last 5 years, I believe. And last year we did over $7 billion in originations, which makes us the second. We're a privately owned company. We're the second largest independently owned companies in the United States. We're actually the largest mortgage company in the Midwest. We do more loans than anybody else, whether you Chase, Wells Fargo, any of the big U.S. Bank. We do more loans than any of those guys. So the reason why is because our concept really is that we want to have people able to call in, talk to a high quality person, talk to somebody who's going to be fair with them and honest with them. And the whole company is about honesty and being upfront with people and giving you the best deal that we can every day on any product that you're looking for. So that's really about Guaranteed Rate. There's a bunch about our growth, that type of thing. So programs that are available, there are a lot of different programs that are available for you guys when you're looking for homes, and we'll kind of go through each of those to kind of explain them, because each one has a purpose. There's FHA and VA loans. There's the conventional fixed or adjustable rate mortgages. Okay. There's jumbo loans, and then there's an affordable housing programs. Okay. First of all, FHA loans. What is that? A lot of people think, oh, you have to hardly make any money to get those. That's untrue. Actually, anybody can get those. If you're making $1 million a year, you can get an FHA loan. As long as it's your primary home. So these are just loans that are actually guaranteed by the federal government. So if it goes bad, the government insures it. The bank doesn't have to worry about anything. That's their baby. And so a lot of times you'll see FHA loans actually have a more competitive interest rate than what you would get on a conventional loan, which is surprising. Like, for example, I believe on Friday we're probably at 3.875 on a 30-year fixed for a conventional loan. If you meet all the criteria, that type of thing, we're probably at like 3.625 on an FHA loan, 30-year fixed, which is amazing. The good thing about it is that you only have to put 3.5% down as a down payment. That down payment can actually come as a gift. So mom, dad, brother, sister, uncle, aunt, they can give you a gift, give you the whole amount as a gift. You don't have to have any of your own money to put down as a down payment. It's perfect for first-time home buyers. Really good program for that. More flexible credit guidelines, much easier to qualify. You can have as low as a 620 credit score, get approved pretty easily. What happens, usually when I get you pre-approved, I'll take your asset and income information, I'll pull your credit, and then what I do is I take all that stuff and I run it through an underwriting system. Now the underwriting system takes all this into account depending on what type of loan program you're going to do. So an FHA loan, if I run it through the underwriting system, it is much more lenient. And what happens when I run it through there, it'll come back, it'll say approved or not approved. So as you can imagine, sometimes I'm like, oh, it's like beep, 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 beep. I'm like, oh, please say approved. You know? And so on FHA, it's a little bit easier. It'll come back, like I could run one person through at 620 and on an FHA loan, it would be approved. If I ran them through on a conventional loan, they would not be approved because of the credit score being so low. Okay. Also, you can do co-signers. So, for example, this works good for somebody who maybe just got out of college or they're in college and they want to buy a home. What I can do is I can get mom or dad to co-sign for them. Even though they don't make any money, I could use mom and dad's money that they make and qualify them based on their income. So it works good for that type of situation as well. So that's the reason why, usually why you would use FHA loan would be lower credit scores, maybe they don't have the down payment money themselves, things like that. Maybe other flexibilities, and usually I'll help you guide you through that if you need an FHA loan or not. A VA loan is a little bit different. I don't know if any of you are veterans. More than likely not, right? Are you? No? Okay. Well, I won't spend a lot of time. These are really good because you can do 0 down payments, and there is no PMI on these. You can do 100% financing. Really good program. So the veterans, I'll tell you what, man, when I do these things are awesome. That's a good deal. Good for them. Conventional and jumbos. Okay, conventional loans, you hear this all the time. Basically, we're going to do that through conventional sources. And you have a conforming size loan. Conforming size loan is up to $417,000. Basically, up to $417,000, we can do Fannie Mae, Freddie Mac loans. That's where you can get the best pricing and the most aggressive programs. You can do as little as 3% down on a conforming conventional loan, okay? But then you have to buy PMI, which is private mortgage insurance, if you don't put down at least 20%, okay?
Or is it 25%?
No, 20% for PMI, 25% for the pricing.
Oh, okay.
So that's what, now I'll kind of get into that too and how that
Even
all
for
works.
condos, it's 20%, or was it 25?
20%. Yeah, 20%. But then you get, so what happens these days, they kind of change some of the rules on the pricing part of it, okay? If you don't put down 25% and you're buying a condo, normally if we have a posted rate of, let's say, 3.875, which it was on Friday, normally you're going to get like 4 or 4.125 if you don't put down 25%. They basically hit us. It's these loan level price adjusters. There's different price adjusters, one being for down payment, one being for credit score, type of property, that type of thing. So for example, on a condo, if you put down 20%, that's great, but then you're going to get hit with